Setting realistic investment goals is the cornerstone of a successful financial journey. Without clear and achievable targets, it's easy to lose direction or take unnecessary risks. In this quick guide, we'll explore how to define goals that match your financial situation, timeline, and risk tolerance, helping you make smarter decisions and build a portfolio that works for you. Whether you're saving for retirement, a home, or just growing your wealth, learning to set realistic goals is the first step toward financial confidence and long-term success. Today we will talk about how to set realistic investment goals. So before we start, make sure to hit the like button and subscribe to my channel. 1. Understanding your financial objectives. The foundation of setting realistic investment goals begins with a clear understanding of your financial objectives. Before you start investing, it's crucial to define what you want to achieve. Are you saving for retirement, buying a home, funding a child's education, or building an emergency fund? Each goal demands a different investment approach. Start by evaluating your current financial situation, including income, expenses, debts, and existing savings. This self-assessment helps establish how much you can realistically invest and over what time frame. Goals should be specific, measurable, and time-bound. For instance, instead of a vague goal like save money, aim for accumulate $50,000 for a home down payment in 5 years. Clear objectives provide direction and motivation, guiding your investment choices. It also helps you prioritize your goals, especially if you have multiple objectives competing for your resources. Knowing exactly what you want to achieve allows you to design a tailored investment plan, selecting the appropriate vehicles, risk level, and strategies suited to your unique needs and timelines. 2. Differentiating short-term and long-term goals. Investment goals can broadly be categorized into short-term and long-term, and understanding this distinction is vital for setting realistic expectations. Short-term goals typically span from 1 to 3 years and include things like buying a car, going on a vacation, or building an emergency fund. These goals require a conservative investment approach focused on preserving capital and liquidity, because you'll need access to funds relatively soon. Long-term goals, such as retirement planning or saving for your child's college education, often span 5 years or more, allowing you to invest in riskier assets, like stocks or real estate with higher growth potential. Because of the extended timeline, you can tolerate short-term market volatility. Properly classifying your goals by timeline helps determine asset allocation and risk tolerance. Mixing investment strategies for short and long-term objectives without consideration can jeopardize your progress or expose you to unnecessary risk. By clearly distinguishing the timeline and purpose of each goal, you can build a portfolio that balances safety and growth aligned to your financial future. 3. Assessing risk tolerance and capacity. A crucial part of setting realistic investment goals involves understanding your risk tolerance and risk capacity. Risk tolerance refers to your emotional comfort with fluctuations in your investment's value, while risk capacity is your financial ability to endure those fluctuations. Both factors are intertwined and impact how aggressively you should invest. For example, if you're young with a stable income and a long timeline, you might tolerate higher risk for greater potential returns. Conversely, someone nearing retirement might prefer a more conservative approach to protect accumulated wealth. Overestimating your risk tolerance may lead to panic selling during market downturns, hurting your long-term results. Underestimating it might cause you to miss growth opportunities. Assessing risk tolerance honestly is essential, considering your personality, financial situation, investment experience, and the stability of your income. Various questionnaires and tools exist to help measure this. 4. Making goals specific and measurable. Investment goals must be specific and measurable to be effective. Vague goals like grow my wealth or invest wisely lack clarity and make it difficult to track progress or take actionable steps. A specific goal defines the amount you want to accumulate, the purpose of the investment, and the time frame for achievement. For example, save $200,000 for retirement in 20 years is a concrete goal that allows you to develop a detailed plan. Measurable goals let you monitor your progress regularly, making adjustments when necessary. Using benchmarks such as annual savings targets, rate of return expectations, or milestone checkpoints improves accountability and motivation. It also helps avoid procrastination and impulsive decisions by providing a clear roadmap. Additionally, tracking progress helps you identify whether your investment strategy is working or if you need to increase contributions, reduce expenses, or modify asset allocation. 5. accounting for inflation and taxes. Realistic investment goal setting requires accounting for inflation and taxes, which can significantly impact your purchasing power and net returns. Inflation erodes the real value of money over time, meaning that the amount you save today may not cover the same expenses in the future. For example, if you plan to save $100,000 for a college education in 15 years, you need to factor in rising tuition costs caused by inflation. Ignoring inflation can lead to underfunded goals and financial shortfalls. Similarly, taxes reduce your effective returns and vary depending on the investment type and jurisdiction. Capital gains, dividends, and interest income might be taxed differently, and certain accounts offer tax advantages. Understanding how taxes affect your investment returns helps in choosing tax-efficient strategies and accounts such as IRAs, 400 and ONEX, or tax-free municipal bonds. 6. The importance of diversification. Diversification is a vital strategy in setting realistic investment goals because it helps manage risk and smooth returns. By spreading your investments across different asset classes, such as stocks, bonds, real estate, and cash, and across sectors and geographies, you reduce the impact of any single investment's poor performance. This balance helps protect your portfolio from significant losses while still allowing for growth potential. Diversification should align with your investment goals, risk tolerance, and timeline. For example, a long-term goal like retirement may include a higher allocation to equities for growth, while a short-term goal might emphasize bonds and cash equivalents for stability. Regularly rebalancing your portfolio is necessary to maintain your desired risk profile and goal alignment as markets fluctuate. Without diversification, your investment portfolio may become overly exposed to risks, jeopardizing the likelihood of achieving your financial objectives. 7. Preparing for uncertainties and emergencies. Setting realistic investment goals also involves preparing for life's uncertainties. Unexpected events such as job loss, health emergencies, or economic downturns can disrupt your financial plans. Having a well-funded emergency fund, typically covering 3 to 6 months of living expenses, acts as a financial buffer that prevents you from prematurely withdrawing investments, which could undermine your long-term goals. Insurance coverage, health, disability, life, and property is another important safeguard to protect against catastrophic expenses. Realistic planning means accepting that not everything will go as expected and building resilience into your financial strategy. This preparation helps maintain investment discipline during difficult times, allowing your portfolio to grow uninterrupted and your goals to remain attainable despite setbacks. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.